Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Shut up and take my money.
That is an all-time low.
And the old bear is back.
I'd buy that for $1.
Telling me, dream.
Hello and welcome back to another edition of Buy or Sell, coming to you from the No Holds Bar here at Equity Mates HQ. I'm your host, Adam Keily, widely regarded as one of the simplest minds in finance, but luckily for us, as always, I'm joined by an expert to educate me and hopefully you on how they're thinking about stocks and the stocks they're thinking about. But this isn't a deep dive. We're going to get through as many stocks as we can in the time that we've got. You can, of course, find out more about each stock on the Equity Mates website. And today I am chuffed to be joined in the No Holds Bar by Ben Rundle, partner and portfolio manager at Hayborough Investment Partners. Welcome, Ben.
Thank you, Adam. Thanks for having me on.
Ben, we like to kick things off in the No Holds Bar with a beverage, and we have a signature cocktail every week on the show. And the signature cocktail today is the Aloha Breeze Pizza Colada. This cocktail is actually invented by Domino's Pizza, who we're talking about today on the show. So I thought it was only appropriate to offer you a pizza colada. They invented a range of cocktails, believe it or not, for Valentine's Day as part of a promo. So I thought we'd better offer you that one today. A pizza colada for you, Ben, or something else? What's your drink of choice?
Look, I'm not a cocktail man, but I'm going to try your suggestion. I'm just pretty vanilla, just a beer or something.
Just a beer? Yeah, we can organise that.
We'll cocktail for this occasion.
Yeah, I find the cheese in the pizza colada just gets a bit stuck in your teeth. All right, let's crack on with the show. We've got plenty to get through. Got some really great stocks, I've got to say. I'm looking forward to this one, and we're going to start it off with Redox Proprietary Limited, ASX RDX, currently trading at $3.28. I initially saw this and thought it was Redox, the bath salt making company. I thought, what a nice relaxing way to ease into the show. But no, Redox, a chemical distributor, is that right?
Yeah, Redox are they're a distributor of chemical products in Australasia, and they've got a smaller business in the US as well.
Yeah.
They listed on the stock market a little over 12 months ago. So it's my view that I don't think people have had enough time with the business to see the high quality nature of it. And I do think it's a fairly high quality business. They've got a very long operating track record. But the numbers on the business, I think, are really impressive. They've had average revenue growth of 12% over the past 30 years, and it's 11% over the past 10 years. Now, obviously, the question is whether they can keep delivering on that growth, but I don't think it needs to be that high to make good money. So over the past 5 years, their return on capital has been in the low 20% range, which is a very impressive number. And interestingly, if you look at the median valuation for ASX 300 companies with returns on capital above 18%, where Redox obviously sits, the average price to earnings ratio is about 22 times.
Right.
Now, Redox have a huge amount of cash on the balance sheet. So if I adjust for that huge cash balance that they have, I think they're on a cash-adjusted price-earnings ratio about 15 times, which would suggest 45% upside just to hit that median valuation range. So I think there is a valuation increase or a multiple expansion due for the stock, and I think that'll happen over time as people get more comfortable with the business and what their earnings drivers look like.
All right, brilliant. So Redox is a buy for you.
Redox is a buy. I should have said that at the start, shouldn't I?
All good. All good.
I think I'm going to buy.
All right, next up, we're looking at Lifestyle Communities Limited, ASX LIC, currently trading at $8.82. Featured on Channel 7's Sunrise program, and Brekkie TV obviously love the retirement communities, I think, because it's one of the few places you can guarantee that everyone is up at 5 a.m.
Watching it.
Lifestyle Communities, Ben, is that a buy or a sell for you?
Look, I'm a bit conflicted here because I love the management team and think they've done a great job with the business, but I do think that I need to be objective and call it a sell.
Okay, right.
As you suggested, retirement, residential home builder, the model is such that residents will buy a home at substantially less than the median house price of that area. They own the home, but they rent the land, and then they can claim Commonwealth government rent assistance to pay for that rent. Now, Lifestyle, the way the model works is they don't make any development profit when they sell you the home, so it makes the home very cheap up front to the buyer. So it's typically been a great way for people to release some equity in their homes and use that equity to go on a holiday or whatever they like to do with it. The issue, however, is that when lifestyle communities do make money is when the homeowner sells the house, they're entitled to take 20% of the profits. And as the home was purchased fairly cheaply, that 20% can be quite large. Now, recently, as you pointed out, they've had some media attention. Some homeowners have decided to complain about that fee, and they went to the media, and that's affecting home sales now, which is slowing as the buyers become more cautious of the model. Now, the problem is Lifestyle need those sales to be able to fund the development pipeline. So if their sales are slowing, it also means the development pipeline slows. If the development pipeline slows, then you take a hit on the net present value of whatever you're using to value the company. So all in all, that is a combination of a stock, which I think is still a sell.
Right. And we're living longer too. So I guess people are living, they're going to stay around a lot longer than they otherwise would.
Yeah. Well, the residents are going into the villages quite early too. So
yeah, gotcha.
They're hanging around for a while.
All right, Lifestyle is a sell. Next, we're looking at Guzman y Gomez Limited, ASX GYG, currently $29.38. Now, I read that PayPal and Guzman y Gomez have both registered the biggest boost in word of mouth, according to a YouGov brand index for June. Pretty amazing to succeed in the word of mouth space when no one can pronounce your name, Ben. Guzman y Gomez, I believe I've got the pronunciation right, but most people I know just refer to it as that Mexican joint.
Yeah.
Are we buying some Guzman y Gomez?
Yeah, look, I think it's a buy. Most of your listeners would know it, so I don't need to explain.
Yeah.
Personally, I love the food, so maybe it should just be looked at through the Peter Lynch lens, whereby if you love the product,
if you love it, yeah.
I do think it's a buy. I'll be honest, it was a bit hard to get conviction at the IPO given the valuation was fairly stretched, but also the US side of their business is not going particularly well either. But with that said, I think there's enough runway in Australia for them to be able to grow their earnings quite significantly here. The individual store metrics of Guzman's are fantastic. I think they're only bettered in Australia by McDonald's. And the franchisees, which I think is really important, are making good money, and that's absolutely critical, I think, in this business. The other point on the valuation is that it's kind of an ASX nuance, I think, that there are such a limited number of companies on the ASX with the size, the growth runway and the unit economics that Guzman's has. Therefore, the multiple on a business like that is always going to look high in my view. Now, I'm not trying to downplay how expensive the stock is, and admittedly, we don't own it as I was hoping for a cheaper price, but I do think it's a very high quality business, and history has shown that a high quality business listed on the ASX rarely trades an attractive valuation. So I think if they can keep executing the way they are, then the stock will continue to go higher.
And do these guys suffer from a cost of living crisis, or do they kind of benefit as people look for kind of short-term cheap food options?
Yeah, they're certainly not immune from it, but the fact that they've got such a long runway of store openings, I think that they'll still be able to show growth even despite that, if they do get affected by a consumer slowdown.
All right. Guzman y Gomez is a buy.
I think I'm going to buy it.
Next, I promised we were going to talk about Domino's Pizza. We're looking at Domino's Pizza Enterprises Limited, ASX DMP, currently $29.56. I never personally understood the attraction of Domino's Pizza. My wife and I were always a bit like pizza snobs, but then we had kids, and the kids just want ham, cheese, maybe pineapple sitting on top of a loaf of bread, pretty much.
Simple.
So, so I can see that people do love their Domino's. Domino's, buy or sell for you though, Ben?
Look, Domino's is a sell for me still. The stock has come down a long way, but I still think it's in sell territory. Look, from one fast food chain to another, I think Domino's, despite having fallen so far, I think there's further downside. So unlike GYG, the Domino's franchisees struggle to make good money. Now, that hasn't necessarily hurt the stock in the past, but it certainly doesn't help. The key issue for me is really the net debt of the business, which has absolutely exploded since 2020. High levels of debt in combination with a current store rationalisation that's going on, the lower rate of growth and the high valuation of the business, I think it still trades on a pretty ritzy multiple. I think that's a setup that the short sellers will continue to do well out of. So high levels of debt, store rationalisation and lower growth, I think, is not a combination of a company that's going to do well. So Domino's is a sell for me.
Could struggle to deliver, you might say. Next, we're going to look at this one. We've had this one a few times, and a lot of people are keen on it at the moment, I think. Catapult Group International Limited, ASX CAT, CAT, $2.05. I did read that it was the pick and shovel play for elite sports. I would have gone with bunker rake and heavy roller play, but to each their own. Ben, where are you on Catapult? Is it a buy or a sell?
Look, I think it's a buy. So, hopefully that lines up with the rest of the...
I believe it does. Everyone's been pretty bullish on Catapult that I've talked to. Yeah.
Okay. Look, I think they've got some really good technology. So they're a sports analytics company. They insert a small device into the player's clothing, and then they can track a huge amount of data on that player, which they can provide obviously to the teams, but also to the media as well. They have these devices in AFL, NFL, soccer, F1, you name it. The company estimates they have about 15% penetration into their market, and the next three competitors combined have about 5%. So they clearly have a good technology. Over the past, I'll call it decade, but probably longer, these sporting franchises have just become so much more valuable, and the data that they capture has become far more important to success. So it's my view that given their high levels of penetration, they can probably charge more for their products than they currently do. And I think that the reason they haven't is to try and get that penetration. But once they have that, they can increase their prices. The company is hitting a profitability inflection point, and the fixed cost base is now supportive of a much bigger business. So the incremental revenue growth from here, of which is quite strong, that should drop through to the bottom line at a rate of, call it 30 or 40%. So that should see strong profit growth. And I think that the shares will continue to re-rate higher despite the strong run that they've had. They have had a couple of false starts, so it is up to management to execute on that.
As any good athlete does, Ben. It's a learning experience.
It does, yeah. They've jumped the gun on it.
Very good. And if you are interested in Catapult, Bryce and Alec did a deep dive on Catapult on the Equity Mates Investing podcast feed. So if you haven't seen that and you are interested in Catapult, then make sure you go and check that out. Let's take a break here, grab another beer or another pizza colada if that's your flavour. If you've got a stock you want to hear on the show, then let me know. You can use the contact form at equitymates.com or flick me an email, contact@equitymates.com. We'll be back with more buy or sell right after this.
And the old bear is back.
I'd buy that for $1.
Welcome back. You are listening to Buy or Sell, coming to you from the No Holds Bar, and my expert today is Ben Rundle, partner and portfolio manager at Hayborough Investment Partners. We've got through 5 stocks. We've got a few more to go here, Ben. And next up, we're going to look at Dicker Data Limited, ASX DDR, currently trading at $10.04. DDR also an abbreviation for a type of computer memory. DDR stands for double data rate. But Ben, are we about to double down on DDR, buy or sell?
I think DDR is a buy. So they're a distribution company like Redox that we spoke about earlier, but they're distributing computer equipment. So things like laptops, printers, that sort of thing. Not surprisingly, the company had a fantastic period during COVID as every business was buying computer equipment to set up their staff at home.
Yeah.
Post that, however, the company went into a bit of a hangover, if you like, from that spend where people slowed down, and they also got caught with a bit of inventory. But given we're now 3 years, or approaching 3 years post that, I think we're about to head into the upgrade cycle of a lot of that equipment.
Yep.
And I'm hoping that sort of comes at the back end of this year. And on top of that, I think we might, also see demand from things like, AI powered laptops. So the business trades on an early 20s PE multiple, so it's not screamingly cheap. It's ironically the same multiple I think that Redox should be trading on. But they have a much longer ASX operating history. So the market's pretty comfortable with the cycle and where the earnings risks are with DDR. And look, finally, they have a sales incentive structure that pays their key people a low base but rewards them heavily on performance. And I think it's the right system to see them having continued success. So happy to buy Dicker Data.
So I've never heard of them before. Do they just deal direct or through distributors?
Yeah, so if you're a distributor in, call it the US, and you want access to, I think it's something like 8,000 SMEs that Dicker Data have on their database, it's easier to go through a Dicker Data to access all of those in volume than it is to try and do it yourself. So that's where I think the power of the distribution network sits.
Yeah, interesting. All right, so DDR is a buy.
I think I'm going to buy it.
Next, we're going to look at Growthpoint Properties Australia Limited, ASX GOZ, currently $2.30. And I have to ask this because I love a good pun. Growthpoint Properties, please tell me it's set for growth.
We hope the share price is set for growth. The portfolio, I wouldn't say, is in
right, yeah,
at the moment. But so Growthpoint, as you suggested, it's a real estate investment trust. I think it's a buy.
Okay.
Their portfolio is about 1/3 industrial property and it's 2/3 office, which is a bit of a tale of two stories at the moment, because industrial property has been doing really well with positive re-leasing spreads, whilst office has been the opposite, with consistent valuation markdowns in the value of their property coming from both interest rate increases as well as rising occupancy levels too. So, but with all that said, I think the share price is factoring in a lot of that. So the stated value of their assets per share is around $3.50. And the shares are trading at $2.30. Now, that asset valuation has been coming down in the past few results, so we might not be quite at the bottom yet, but I think the shares will move higher quite quickly once the market becomes more certain that the downside is fairly limited with that NTA. So if I conservatively say the NTA still comes down and bottoms out around $3.25, then maybe there's 30 to 40% upside in it. So I think it's pretty good buying at these levels.
All right, Growthpoint is a buy.
I think I'm going to buy it.
Next, we've got Eagers Automotive Limited, ASX APE, currently $10.55. Now, I had no idea about these guys either, but it turns out they manage all my favourite car dealerships. They got Audi, BMW, Porsche. I can't afford any of them, obviously, but they do make for good window shopping. Ben, are we buying or selling Eagers Automotive?
Eagers Automotive, I think, is a sell.
Sell.
I will caveat that by saying it is a very well-run business, but I'll run through my reasoning in just a sec. So, yeah, as he suggested, they're one of the largest car dealerships in Australia. Been running a very long time, very well-run business, and it's got a great management team. It was quite well documented during that COVID period that there was a wait list on a lot of cars as parts were hard to come by. And manufacturing had been slowed down, obviously. That wait list is still being delivered, and in actual fact, new car delivery volumes have been very high recently, in fact, almost hitting records in some months. And so it's my view that the high delivery volumes are telling us that supply availability has improved significantly, and we're coming to the end of those high delivery levels. So coupled with that, it's no secret that the consumer has slowed their rate of spending at the same time. So it's my view that we're headed for a perfect storm whereby supply has improved at the same time as spending is slowing. So you have these car yards full of unsold cars. Now, given dealerships operate with a high level of floor plate financing, so they don't actually fund the cars up front, when the cycle turns, as I think it is at the moment, it causes all sorts of operating deleverage problems in the accounts. So while I would reiterate that it's a great business, and Nick Politis, who is on the board and knows this industry better than anyone, has been buying stock in Eagers at the moment, I think he has a much longer term view than most. So if you were to buy it now and hold it for 5 to 10 years, I think you would do okay. But in the short term, I think it's to sell at these levels.
Sell!
It feels like one of those things you wouldn't want to be stuck with either, like car inventory which is just going to sit there and age, basically. Like, you're not going to get any more for that car if you in a year's time or whatever it is. So you need to kind of,
pretty hard to move at certain periods, and it hasn't been the case over the last few years.
Next, we've got Paragon Care Limited, ASX PGC, currently trading at 46 cents. Paragon Care, provider of equipment, devices and consumables to the healthcare market. What I found was it's the only place where you can get a therapeutic laser for your horse and a 24/7 help desk for your hospital. Ben, Paragon Care, is it a buy or a sell?
I think it's a buy. I'm quite excited by this management team.
Right.
I would highlight the stock has had a very good run over the last few months, so maybe it's due a bit of a breather, but I still think it's a buy here. Look, they are a medical product distribution company, and it recently underwent a merger with a group called CH2. So CH2 were an unlisted business that's now been merged with the listed Paragon. CH2 are a wholesaler of medicines to hospitals and pharmacies. Typically, these medical wholesaling businesses are very competitive and they operate on very thin margins, so they require a pretty sharp and savvy management team to do well out of them. The CH2 management team, in my view, admittedly in the very short time of knowing them, they've impressed me a great deal, and they're laser focused on cost, and they use that cost advantage to lower the end cost that their customers pay for the products, which is a model that I've seen in other industries work very, very well, and I think it can potentially work well here too. The existing Paragon business that they merged with, it also has much higher margins than CH2 does. So for a management team to come in and operate a business on much higher margins, I think that they're going to relish having a higher cost base in which to remove costs from. So I think as more people and investors get to know and understand the CH2 management team, the more they'll get comfortable with the longer term story for the company.
Right.
It has had a good run, but I do think it's still a buy at these levels.
So that typically happens, does it? Where two companies coming together, there's a bit of trepidation for a while as people see sort of how it's all going to play out and how the new organisation's going to operate, and then get that comfort, as you say, and then you sort of people start buying in and increasing their positions?
Well, certainly in some scenarios. So the management team is the management team of the unlisted side of the business, so they're now running the full Paragon business. So a lot of investors haven't had the time, or experience with the management team. So it tends to take a little bit of time for fund managers to meet the management team, get comfortable with their strategy, and get comfortable with understanding the business as well. So I think that's started to happen, but I think it continues to happen, over the next 6 to 12 months.
I think I'm going to buy it.
Paragon Care is a buy, and that brings us to time for the last call here in the No Holds Bar.
Let's go!
Finally on the show today, we're looking at DUG Technology Limited, ASX DUG, currently $2.73. Sounds like a dodgy uncle. DUG is up on the share market. Meanwhile, Gary trading at all-time lows. Ben, where are we at with DUG, buy or a sell?
I think DUG is a buy.
Screaming buy, I love it.
Yeah, look, I do think it's a really exciting business. It's also, I think with DUG, you have a situation where the macro and the micro are both lining up for them at the same time. So for the layman, that just means that the industry and the company are doing well at the same time, which is a great combination to have, obviously. So what they do, when a oil and gas company does a seismic survey to find underground oil reserves, the amount of computer power required to process that data is enormous. Now, DUG have a network of high-powered computers to be able to process that data. It sounds a lot more technical than what it is. Essentially, it's just a lot of computers plugged in together. The industry is growing rapidly. That's being driven by these oil and gas companies. They're spending up to 50% of the cost of a seismic study on data processing now. And if we go back 5 years, that was only about 10%. So spend on processing the data has improved quite significantly, and that's driving industry growth. On top of that, they've also internally developed their own software to improve the analysis of that data, and that is getting great traction with their customers and is a less cyclical part of the business. It now makes up about 11% of their revenue. So the two main overseas players who do the same thing as DUG, I think they're not bad businesses, but DUG look to be taking market share from them, and I believe they'll continue to do so. I mentioned they've got a strong industry tailwind behind them, and combined with their internally developed software, I think they'll make a lot of money from that, they'll attract a lot of new customers, and they'll continue to grow their market share in the industry. Now, it's not the most perfect model in the world, because as the more computing power they need, the more they have to spend on capital expenditure to go and buy that equipment. But I think that the industry tailwinds will keep the earnings going in the right direction. And on my numbers, the stock isn't screamingly expensive at the moment, so I think it's a good small cap to buy.
Good buy. All right, the future looks bright for Doug, which is great.
I think I'm going to buy it.
Ben Rundle, thank you so much for joining me in the No Holds Bar. Where can people find you if they'd like to hear more from you and the team?
Our website is hayboroughinvest.com.au. We're on LinkedIn, we're on Twitter.
Yep.
It's about as far as our social media presence goes.
Haven't made any TikTok dance videos, Ben?
No, we're not off that deal. No, look, the website's probably the best place, and all our contact details are on there if you ever want to have a chat to us.
All right, brilliant. And of course, you can continue the journey on the Equity Mates website as well. There's plenty of resources there. You'll find the buy or sell tracker along with the find a company page, where you can get more info on each of the companies we've talked about today. Thank you so much for joining us. Don't forget, you'll find us on YouTube as well. I hope you'll join me next time when we jump back into the No Holds Bar. But until then, it is bye for now.